You have a number in your head. Maybe it's $100, maybe it's $200. You are sitting on your stack of silver, watching the charts, waiting for the price to hit that magic number so you can sell and retire. You think the free market is going to pay you. I have bad news. The financial history of the last 300 years suggests that long before silver hits $100, the game will be paused. The rules will be rewritten, and the free market will be replaced by national security. We saw it in 1980, we saw it in 1933, and in 2026, with silver becoming a critical strategic metal for missiles and AI, do you really think the government will let you squeeze them? In this episode, we are investigating the price control trap. We will use three ancient economic laws, Gresham's law, the Cantillon Effect, and the Pareto principle, to prove why the official price of silver might never reach $100, even if the real value is far higher. To understand the future, we must look at the crime scene of 1980. The Hunt brothers had cornered the silver market. The price went from $6 to $50. The shorts, the establishment banks, were facing bankruptcy. Did the government let the free market work? Did they let the banks fail? No, they changed the rules. On January 21, 1980, the COMEX changed the leverage rules. They declared liquidation only. You could sell, but you couldn't buy. They raised margin requirements so high that the Hunts were forced to margin call. The price crashed not because of supply and demand, but because of a bureaucratic edit. In 2026, the stakes are higher. It's not just banks losing money. It's the Defense Department losing missiles. If silver hits $80 again, expect the Exchange Stabilization Fund or the COMEX to intervene. They won't ban silver, they will just make it impossible to buy it legally. This brings us to the first of the 300-year-old laws that govern this crisis, Gresham's law. It states simply, bad money drives out good. When the government fixes the price of a currency below its real value, the real money disappears from circulation. Let's say the government sets a price cap on silver at $50 to protect the solar industry. But the global market value is $100. What happens? Does the price stay at $50? On paper, yes. In reality, every ounce of silver vanishes. Miners stop selling. Refiners hold back stock. You, the stacker, bury your coins in the backyard. No one sells an asset for 50% off. The official market dries up. You go to a coin shop, and the shelves are empty. But in the shadows, a black market forms. This is where the real price discovery happens. So when you ask, will silver hit $100? The answer is yes, but you might not see it on the TV screen. You'll see it in the alleyway. The second law is the Cantillon Effect. This law explains who gets the metal during a shortage. Cantillon taught us that money, or resources, is not neutral. It enters the system at specific points. The people closest to the source benefit, the people furthest away suffer. If the U.S. government invokes the Defense Production Act for silver, which they likely will for Raytheon and Lockheed Martin, they become the Cantillon insiders. They get the first right of refusal on all refinery output at the capped price. They get the metal to build the missiles and the satellites. You, the retail investor, you are at the end of the line. By the time the metal reaches you, the premium is 100% or it's illegal to buy. This creates a two-tier system. Tier 1, strategic industry, gets silver cheap. Tier 2, the people, get inflation and paper promises. This is not a conspiracy. It is standard operating procedure during wartime economies. The final law is the Pareto principle, the 80-20 rule. In any distribution, 20% of the people own 80% of the assets. When price controls hit, this concentration gets extreme. The 20% who understand Gresham's law, the smart money, will hold 80% of the physical silver. The 80% of the population who trust the official price will sell their silver to the government at the capped rate, thinking they are being patriotic or avoiding trouble. This is the greatest wealth transfer mechanism in history. The masses trade real assets for paper money at a fixed price. The elites trade paper money for real assets at the black market price. By the time the price cap is lifted, years later, the silver has moved from the hands of the many to the hands of the few. So, knowing these 300-year-old laws, what is the playbook for episode 40? 1. Ignore the spot price. If the government intervenes, the spot price on your screen becomes a lie. It is the price of paper, not metal. Stop looking at it. Watch the street price, the cost to actually get a bar in your hand. 2. Physical possession is non-negotiable. If you hold SLV, the ETF, or unallocated pool silver, and the Defense Production Act hits, you will be cashed out at the official price. You will get a check, not metal. Only physical possession protects you from the Cantillon Effect. 3. Prepare for the windfall tax. Even if they don't ban silver, they might tax the profit. If silver hits $100, expect a 50% tax on the gain. The smart money never sells. They borrow against the asset. The government cannot print silver. That is your edge. But they can print laws. That is their weapon. Be ready for the rules to change. The free market is a beautiful thing, but it is rarely allowed to exist in a crisis. We are entering a period where silver is too valuable to be left to the free market. Don't wait for $100 to validate your thesis. The validation is the fact that they are trying to stop it. This is the smart money wisdoms. The future belongs to the owners.